Understanding cash flows is our reading 25 for the CFA Level 1 program curriculum reading. Understanding cash flow statements. Learning outcomes, the candidate should be able to compare cash flows from operating, investing, and financing activities and classify cash flow items as related to one of these three categories given as a description of the item. Describe how non-cash investing and financial activities are reported. Contrast cash flow statements prepared under International Financial Reporting Standards, IFRS, and U.S. Generally Accepted Accounting Practices or Principles, USGAAP, distinguish between direct and indirect methods of presenting cash from operating activities and describe arguments in favor of each method. Describe how cash flows statements is linked to the income statements and the balance sheet. Describe the steps in the preparation of direct and indirect cash flow statements, including how cash flows are computed using income statements and balance sheet data. Convert cash flows from indirect to direct methods. Analyze and interpret both reported and common size cash flow statements. Calculate and interpret free cash flows from the firm, free cash flows to equity, and performance of coverage cash flow ratios. Introduction. The cash flow statement provides information about a company's cash flow receipts and cash payments during an accounting period. The cash-based information provided by the cash flow statement contrasts with the actual accrual-based information from the income statement. For example, the income statement reflects revenue when earned rather than when cash is collected. In contrast, the cash flow statements reflects cash receipts when collected as opposed to when the revenue was earned. Reconciliation between reported income and cash flows from operating activities provides useful information about when, whether, and how a company is able to generate cash from its operating activities. Although income is an important measure of its results of a company's activity, cash flows is also essential. As an extreme illustration, a hypothetical company can make all sales an account without regard to whether it will ever collect its account receivables. When report healthy sales on income statement and might well report significant income. However, with zero cash inflow, the company would not survive. The cash flow statement also provides a reconciliation of the beginning and end cash on the balance sheet. In addition to information about cash generated or alternatively cash used in operating activity, the cash flow statements provides information about cash provided or used in a company's investing and financing activities. This information allows the analyst to answer such questions as: does the company generate enough cash from its operations to pay for its new investments, or is the company relying on new debt issuance to finance them? Does the company pay its dividends to common shareholders or using cash generated from operating operations from selling assets or from issuing debt? Answers of these questions are important because in theory, generating cash from operation can continue indefinitely, but generating cash from selling assets, for example, is possible only as long as there are assets to sell. Similarly, generating cash from debt financing is possible only as lenders are willing to lend, and the lending decisions depends on the expectations of the company will ultimately have adequate cash to repay the obligations. In summary, information about the source of and use of cash helps creditors, investors, and other statement users evaluate the company's liquidity, solvency, and financial flexibility. This reading explains how cash flow activities are reflected in a company's cash flow statements. This reading is organized as follows. Section 2 describes the components and format of cash flow statements, including the classification of cash flows under IFRS and US GAAP, and the direct and indirect formats for presenting the cash flow statements. Section 3 discusses the linkage of the cash flow statements with the income statements and balance sheet and the steps in preparing the cash flow statement. Section 4 demonstrates an analysis of cash flow statements, including the conversion of indirect cash flow statements to the direct method and how to use common size cash flow analysis. Free cash flow measures and cash flow ratios used in security analysis. A summary of the key points and practice problems in the CFA Institute multiple choice format concludes the reading. Component and format of the cash flow statement. analyst needs to be able to extract and interpret information on cash flows from for financial statements. The basic components and are allowable formats of the cash flow statements are well established. The cash flow statement has the subsections relating specific items to the operating, investing, and financing activities of the company. Two presentation formats for operating sections are allowable, direct and indirect. The following discussion presents these topics in greater detail. Classification of cash flows and non-cash activities. All companies engage in operating, investing, and financing activities. These activities are classified using classifications used to cash flow statements under both IFRS and US GAAP and are disclosed as following. Operating activities include the company's day-to-day activities that creates revenue, such as selling inventory, providing services, and other activities not classified as investing or financing. Cash inflows result from cash sales and from collections of accounts receivables. For example, examples include cash receipts from the provision of services and royalties, commissions, and other revenue. To generate revenue, companies undertake such activities as manufacturing inventory, purchasing inventory from suppliers, and paying employees. Cash outflows result from cash payments for inventory, salaries, taxes, and other operating expenses, and from paying accounts payable. Additionally, operating activities include cash receipts and payments related to dealing securities or trading securities. Investing activities includes purchasing or selling long-term assets and other investments. These long-term assets and other investments include property, plants, and equipment, intangible assets, and long-term assets. Both long-term and short-term investigations and equity and debt, bonds and loans issued by other companies for this purpose, investment in equity and debt services exclude any securities considered cash equivalents, securities held for dealing or trading purposes, to purchase the sales of which are considered operating activities, even for companies where this is not a primary business activity. Cash inflows in the investing category include cash receipts from the sale of non-trading securities, property, plants, and equipment, intangibles, and long-term assets. Cash outflows include cash payments for the purchase of these assets. Financing activities include obtaining or repaying capital, such as equity and long-term debt. The two primary sources of capital are shareholders and creditors. Cash inflows in this category includes cash receipts from issuing stocks or common and preferred or bonds, and cash receipts from borrowing. Cash outflows includes cash payments to repurchase stock, e.g. treasury stock, and to repay bonds and other borrowings. Note that indirect borrowing using accounts payable is not considered a financing activity, such as borrowing is classified as an operating activity. The new IFRS standard relating to lease accounting affects how operating lease are represented in the cash flow statements. Under IFRS 16, operating lease are treated similarly to financial leases. That is, the interest component of lease payments will be reflected in either the operating or financing section, and the principal component of lease payments is included in the financing section. IFRS provides companies with choices in reporting some items of cash flows, particularly interest and dividends. IFRS explains that although the financial institution's interest paid and received would normally be classified as operating activities for other entities, alternative classifications may be appropriate. For these reasons, under IFRS, interest received may be classified either as an operating activity or as an investing activity. Under IFRS, interest paid may be classified as either an operating activity or a financing activity. Furthermore, under IFRS, dividends received may be classified as either an operating activity or an investing activity, and dividends paid may be classified as either an operating activity or a financing activity. Companies may use a consistent classification for year to year and disclose separately the amount of interest and dividends received and paid, and where the amounts are reported. Under US GAAP, discretion is not permitted in classifying interest and dividends. Interest received and interest paid are reported as operating activities for all companies. Under US GAAP, dividends received are always reported as operating activities, and dividends paid are always reported as financial activities. Let me drink my coconut water. Companies may also engage in non-cash investing in financial transactions. A non-cash transaction is any transaction that does not involve an inflow or outflow of cash. For example, if a company exchanges one non-monetary asset for another non-monetary asset, no cash is involved. Similarly, no cash is involved when a company issues common stock either for dividends or in connection with a conversion. These transactions are not incorporated in the cash flow statements. However, because such transactions may affect a company's capital or asset structure, any significant non-cash transactions is required to be disclosed either in a separate note or a supplementary schedule to the cash flow statement. A summary of differences between IFRS and US GAAP. As highlighted in the previous section, there are some differences in cash flow statements prepared under IFRS and US GAAP that the analyst should be aware of when comparing the cash flow statements of companies prepared in accordance with different sets of standards. The key differences are summarized in Exhibit 1. Most significantly, IFRS allows for more flexibility in reporting of such items as interest paid or received and dividends paid or received and how income tax expenses are classified. USGAAP classified interest and dividend received as investment and operating activities, whereas IFRS allows companies to classify these items as either operating or investing cash flows. Likewise, USGAP classifies interest expense as an operating activity, even though the principal amount of the debt issued is classified as a financial activity. IFRS allows companies to classify interest expense as either an operating activity or a financial activity. USGAP classifies dividends paid to shareholders as financial activities, whereas IFRS allows companies to classify dividend paid as either an operating activity or a financial activity. USGAP classifies all income tax expenses as operating activities. IFRS also classifies income tax expenses as operating activities unless the tax expense can be specifically identified with the investing or financing activity, e.g. the tax effects of sales of a discounted operation could be classified under investing activities. Direct and indirect methods of reporting cash flows from operating activities. There are two acceptable formats for reporting cash flows from operating activities, defined as net amounts of cash provided for operating activities. The direct and indirect methods, the amount of operating cash flows from flow is identical under both the methods. Under only the presentation format and operating cash flow section differs. This presentation format of cash flows from investing and financing is also exactly the same, regardless of which method is used to present operating cash flows. The direct method shows the specific cash inflows and outflows that result in reporting cash flows from operating activities. It shows each cash inflows and outflows relating to the company's cash receipts and disbursements. In other words, the direct method eliminates any impact of accruals and shows only cash receipts and cash payments. The primary argument in favor of the direct method is that it provides information on the specific source of operating cash receipt and payment. This is in contrast to the indirect method, which shows only the net results of these receipts and payments, just as information of the specific source of revenue and expenses is more useful than knowing only the net results. Net income, the analyst gets additional information from a direct format cash flow statement. The additional information is useful in understanding historical performance and predicting future operating cash flows. The indirect method shows how cash flows from operations can be obtained from reporting net income as a result of a series of adjustments. The indirect format begins with net income to reconcile net income with operating cash flows. Adjustments are made for non-cash items and non-operating items for the net changes in operating accruals. The main arguments for the indirect approach is that it shows the reasons for differences between net income and operating cash flow. Another argument for the indirect method is that it mirrors a forecasting approach that begins by forecasting future income and then derives cash by adjusting for changes in balance sheet accounts that occurs because of the timing differences between accrual and cash accounting. IFRS and USGAP both both encourage the use of direct methods but permits either methods. USGAP encourages the use of direct method, but also requires companies to present a reconciliation between net income and cash flows, which is equivalent to the indirect method. In the indirect method, if the indirect method is chosen, no direct format disclosures are required. The majority of companies reporting under IFRS and USGAP using the indirect method for operating cash flows. Many users of financial statements prefer the direct method, particularly analysts and commercial lenders, because the importance of information about operating receipts and payments is assessing a company's financial needs and the capacity to repay existing obligation. Preparers argue that adjusting net income to operating cash flows as an indirect format is easier and less costly than reporting gross operating costs, receipts, and payments as in the direct format, which advances in accounting systems and technology. It is not clear that generating the information required to use the direct method is difficult or costly. CFA Institute has advocated that standard setting requires the use of direct formats for main presentation and cash flow statements, where indirect cash flows are supplementary disclosures. An indirect format cash flow statement prepared under IFRS. Exhibit 2 presents the consolidation cash flow statement prepared under IFRS from Unilever Group's 2009 annual report. The statement covering the fiscal year ended in 31st of December 2009. 2008 and 2007 shows the use of indirect methods. Unilever is an Anglo-Dutch consumer product company that is headquartered in the United Kingdom and the Netherlands. Beginning first at the bottom of the statement, we note that a cash incurred from 710 million euros at the beginning of 2009, and such amount at the end of 2009, which is a large increase occurring in 2008. To understand the changes, we next estimate the section of the statement. In each year, the primary cash inflows delivered from operating activities, as would be expected for a mature company in a relatively stable industry. In each year, the operating cash flow was more than the reported net profit, again, as would be expected for a mature company, with a large difference primarily arising from add-backs and depreciation. Also, in each year, the operating cash flows was more than enough to cover the company's capital expenditures. For example, was more than enough to cover the company's capital expenditures. For example, in 2009, a company generated such amount in cash flow in operating activities, and as shown in investing section, spent such amount on property, plant, and equipment. Also shown in the investing section, the main reason for a large increase in capital in 2008 was such an amount inflow in the disposure of group companies, joint ventures, and associations. The financing section of the statement shows that each year the company returned about 2.1 billion euros in its common shareholders and around 500 million to its debt holders and preferred shareholders through interest and dividends. The company also repurchased about 1.5 billion in common stock in both 2007, 8, and 9. In 2009, the company repaid debt repayment of such an amount. Okay, having examined each section of the statement, we return to the operating activities section of the Unilever's cash flow statement, which presents a reconciliation of net profit and net cash flows from operating activities, i.e., uses the indirect method, the flowing discussion of certain adjustments to reconcile net profit to operating cost flows, explains some of the main reconciliation adjustments that refers to the amount in 2009. The next adjustments removes from the operating cash flow section is 489 million euros, representing Unilever's shares in joint venture income, and had been included in the computation of net profit, and 201 million euro inflows of cash dividends received from these joint ventures is then shown in the investing activities section. Similarly, 593 million adjustment removes the net financing costs from the operating activities in this section. The next adjustments to operating section is the indirect method statement added back with 1,000 and 38 million euros depreciation, amortization, and impairment, all of which are expenses that have been deducted in the computation of net income, but which did not involve any outflow of cash in the period. The 1,701 million euros adjusted for changes in working capital is necessary because these changes result from applying accrual accounting and thus do not necessarily correspond to the actual cash movement. These adjustments are described in greater detail in a later section. In summary, some observations from an analyst of Unilever's cash flow statements are included such: a direct format cash flow statement prepared under IFRS. In a direct format of the cash flow statement, the cash received from customers as well as other operating items is clearly shown. Exhibit 3 presents a direct method format for a cash flow statement prepared under IFRS. The Telefonica Group, diversified telecommunication company based in Madrid. As shown at the bottom of the statement, cash and cash equivalent increased from 3,792 million at the beginning of 2007 to 9,113 million at the end of 2009. The large increase in cash occurred in 2009, with 2008 showing a decrease. Cash from operations were primarily source of cash, consistent with the profile as a mature company in a relatively stable industry. Each year, the company generated significantly more cash operations than it required for the capital expenditure. For example, in 2009, the company generated 16.1 billion euros cash of operations and spent, as shown in the investing section, only 7.4 billion on property, plant, and equipment. Another notable item for the investing section of the company's limited acquisition activity in 2009 compared with 2008 and 2007. In both 2007 and 2008, the company made over 2 billion in acquisitions, and in 2007, the company received 5.5 billion from disposals. Instead of using cash for acquisitions activities in 2009, when net acquisitions used only 14 million euros, the company invested 1,411 million in financial investments, excluding from cash and cash equivalents. As shown in the financing section, in 2009, the net cash flow from debt issuance was 3,504 million euros. In summary, some observations from the analysis of Telefónica's cash flow statements statement includes total cash and cash equivalent increase over the 3-year period, with 2009 showing the biggest increase. Cash from operating activities were large enough each year to cover the company's capital expenditures. The amount paid for property, plants, and equipment and intangible assets was the largest investing expenditure each year and did not significantly vary from year to year. The company held a significant amount of acquisitions and divestitures activities in 2007 and 2008, but not 2009. A company paid an increasing amount of dividends over the 3 years period. An analyst can also make some comparison between the income statement and the statement of cash flows. For example, contrast the change in revenue from the income statement to the change in cash received from customers. An increase in revenue coupled with a decrease in cash received from customers, for example, could signal collection problems. As shown in Exhibit 3, cash received from customers in 2009 decreased 2.46% compared with 2008 of such an amount. The company reported revenue on the income statement of such an amount. Thus, the decrease in cash received from customers was slightly greater than the 2.1% decrease in total revenue and would not in itself indicate any collection issues. Illustration of cash flow statement prepared under US GAAP. Previously represented cash flow statements prepared under IFRS. In this section, we illustrate cash flow statements prepared under US GAAP. This section provides the cash flow statements of two companies, Tech Data Corporation and Walmart. Tech Data reports its operation activities using the direct method, whereas Walmart reports its operations activities using the more common indirect method. Tech Giant Corporation is the leading distributor of information technology products. Exhibit 4 presents comparative cash flow statements from a company's annual report for the fiscal year end of 31st of January 2008 through 2010. Tech Data Corporation prepares its cash flow statements under the direct method. The company's cash increased from $265 million at the beginning of 2008 to $1.1 billion at the end of January 2010. With the biggest increase occurring the most recent year, 2010 increase was driven by changes across all three sectors of the statement in the cash flow from operating activity sections of Text Data. Text Data's cash flow statements, the company's identifies the amount of cash it received from customers, $21.9 billion for 2010, and the amount of cash that is paid to suppliers and employees, $21.3 billion for 2010. Cash receipts decreased from $24.0 billion in a prior year, but cash paid decreased by even more, such that the cash provided by operating activities increased in 2010 compared with 2009. Net cash provided by operating activities of $543.9 million was adequate to cover the company's investing activities, primarily purchases of property and equipment and software development. Overall investing activities of 2010. Okay. In summary, some observations from an analyst of Tech Data. Statements includes the company's cash increased, the company's operating cash was adequate to cover the company's investments in all 3 years. In 2009, the company issued stock and received financing from the joint venture partner, which provided the company with a stronger cash cushion. Walmart is a global retailer that conducts business under the name Walmart and Sam's Club. Exhibit 5 presents the comparative cash flow statements from the company's annual report for the fiscal year ended in 31st of January 2010, 2009, and 2008. Okay, so this is cash flow. Walmart's cash flow statements indicates the following: cash and cash equivalent change only slightly over the 3 years, from $7.8 billion at the beginning of fiscal 2008 to $7.9 billion at the end of fiscal 2010. But year-to-year cash flow varied significantly. Operating cash flows increased steadily from $20.6 billion in fiscal 2008 to $26.2 billion in 2010. And was significantly greater than the company's expenditures on property and equipment. In every year, in 2009 and 10, the company used cash to repay borrowings, to pay dividends, and to repurchase the common stock. Walmart prepared its cash flow statements under the indirect method. In the cash flow from operating activity sections of Walmart's cash flow statements, the company reconciles its net income of $14.8 billion in net cash provided by operating activities, $22.2 billion. Whenever the indirect method is used, US GAAP mandates disclosure of how much cash was paid for interest and income taxes. Note that these are line items in cash flow statements using the direct method, so disclosure does not have to be mandated. Walmart discloses the amount of cash paid for income tax, $7.4 billion, interest, $2.1 billion, and capital lease obligations, which is $61 million. Okay, at the bottom of its cash flow statement. The cash flow statement linkages and preparation, the indirect format of the cash flow statement demonstrates that changes in balance sheet accounts are an important factor in determining cash flows. The next section addresses the linkages between the cash flow statements and other financial statements. 3.1 linkages of the cash flow statements with the income statement and balance sheet. Recall the accounting equation that summarizes the balance sheet: assets equals liabilities per equity. Cash is an asset. The statement of the cash flow ultimately shows the changes in cash during the accounting period. The beginning and end of balances of cash are shown on the company's balance sheet for the previous and current year. At the bottom of the cash flow statement reconciles beginning cash with ending cash. The relationship stated in general terms is as shown as below. The body of Walmart's cash flow statement shows why the changes in cash occurred. In other words, it shows the company's operating, investing, and financing activities, as well as impact of foreign currency transactions. The beginning and end of balance sheet values of cash and cash equivalents are linked through the cash flow statements. The current assets and current liabilities section of the balance sheet typically reflects the company's operating decisions and activities. Because a company's operating activities are reported on an accrual basis on the income statement, any differences between the accrual basis and the cash basis of accounting for an operating transaction results in an increase or decrease in some, usually short-term assets or liabilities on a balance sheet. For example, if revenue reported using accrual accounting is higher receivable, its expenses reported using accrual accounting are lower than cash actually paid. The result will typically be a decrease in account payables or another accrued liability account. As an example of how items or balance sheets are related to the income statement and or cash flow statement through the changes in the beginning or ending balances, consider accounts receivable. Knowing any three of these four items makes it easy to compute the fourth. For example, if you know beginning account receivables, revenues, and cash collected for customers, you can easily compute ending account receivables. Understanding of interrelationships between the balance sheet, income statements, and cash flow statements is useful is not only understanding the company's financing health, but also in detecting accounting irregularities. Recall the extreme illusions of hypothetical companies that make sales on account without regard to future collection, and thus reports healthy sales and significant income on its income statement, yet lacks cash inflows. Such a pattern would occur if a company improperly recognized revenue balance sheet, and its financing activities typically relate to the equity and long-term debt sections of the balance sheet. Thus, the next section demonstrates the proportions of cash flow information based on income statements and balance sheet information. Steps in preparing the cash flow statements. The preparation of cash flow statements uses data from both the income statement and to comparative balance sheets. As noted earlier, companies often use disclosures to indicate cash flow information, whereas analysts prefer direct format information. Understanding how cash flow information is put together will enable you to take an indirect statement apart and reconfigure it in a more useful manner. The result is an approximation of a direct cash flow statement, which, while not perfectly accurate, can be helpful to an analyst. The following demonstration of how an approximation of a direct cash flow statement is prepared uses the income statement and the comparative balance sheet of Acme Corporation, a fictitious retail company, shown in Exhibit 6 and 7. Operating activities, the direct method. Cash received from customers. Okay, so just interpreting the graph. Cash paid to suppliers. Example 4. Cash paid to employees. To determine the cash paid to employees, it is necessary to adjust salaries and wage expenses by the net changes in salary and wage payables for the year. If salary and wage payables increase during a year, the salary for the expense and vice versa, on a accrual basis will be higher than the amount of cash paid. So the cash paid in salary and wages was 4,113 as follows. Let me drink my coconut water. Okay. cash paid for other operating expenses. To determine the cash paid for other operating expenses, it is necessary to adjust the other operating expense amounts on the income statement by the net changes in prepared expenses and accrued expense liabilities of the year. If prepared expenses increase during the year, other operating expenses on the cash basis would be higher than on the accrual basis, and vice versa. Likewise, accrual basis liabilities increase during the year. Other operating expense on the cash basis would be lower than the accrual basis, and vice versa. Okay, I read that already. Cash paid for interest. The cash paid for interest is included in the operating cash flow under US GAAP and may be included in operating or financing cash flows under IFRS. To determine the cash paid for interest, it is necessary to adjust interest expense by the net changes in interest payables for the year. If interest payable increased during the year, the interest expense on the accrual basis will be higher than the amount of cash paid for interest, and vice versa. The Acme Corporation interest payable decreased by $12, and cash paid paid for interest was $258. As follows. Alternatively, the cash paid for interest may also be determined by the analysis of the interest payable accounts as shown below. Cash paid for income taxes. To determine the cash paid for income taxes, it is necessary to adjust the income tax expense amount on the income statement by the net changes in tax receivables, taxes payables, and deferred income tax for the year. If taxes receivables or deferred tax assets increase during the year, income taxes on a cash basis will be higher than one on accrual basis, and vice versa. Likewise, if taxes payable or deferred tax liabilities increase during the year, income tax expense on one cash basis will be lower than on an accrual basis, and vice versa. For Acme Corporation, the amount of cash paid for income taxes in 2009 was $1,134 as follows. Investing activities. The second and third step in preparing a cash flow statements are determining the total cash flows for investing activities and from financing activities. The presentation of this information is identical regardless of whether the direct or indirect method is used. For operating cash flows, purchases and sales of equipment were the only investing activities undertaken in Acme in 2009, as evident by the fact that the amounts reported for land and building were unchanged during the year. An informational note in Exhibit 7 tells us that the Acme purchased new equipment in 2009 for the total cost of $1,300. However, the account of equipment shown in Acme's balance sheet increased by only $243. Therefore, Acme must have also sold or otherwise disposed of some equipment during the year. To determine the cash inflows and the sales of equipment, we analyze the equipment and accumulated depreciation accounts, as well as the gain on the sale of equipment from Exhibit 6 and 7, assuming that the entire accumulated depreciation is related to equipment. The cash received from sale of equipment is determined as follows. The historical cost of the equipment sold was $1,057. The amount determined is as follows. Long-term debt and common stock. The change in long-term debt based on the beginning of 2009 and ending in 2009 and end of 2009 balance in Exhibit 7 was a decrease of $500 absent other information, and indicates the Acme retired $500 of long-term debt. Retiring long-term debt is cash flow relating to financing activities. Similarly, the change in common stock during 2009 was a decrease of $600 absent other information. Thus indicates that Acme repurchased $600 of its common stock. Repurchases of common stock and also a cash flow relating to financing activities. Let me drink my coconut water. Pour some normal water. Okay. dividends, recall the following relationship: beginning retailed earnings plus net income minus dividends equals ending retailed earnings. Based on this relationship, the amount of cash dividends paid in 2009 can be determined for an analyst of retained earnings as follows, beginning back, so you just literally calculate that. Overall statement of cash flows, the direct method. Exhibit 8 summarizes the information about Acme's operation. Acme reminds me of Padme for some reason from Star Wars. Anyways, Star Wars have Padme and Anakin Skywalker falling in love. Investing and financing cash flows in the statement of cash flows. At the bottom of the statement, the total net change in cash is shown to be a decrease from 152. This decrease can also be seen as a comparative balance sheet. In Exhibit 7, the cash provided by operating activities of 2,606 was adequate to cover the net cash used in investing activities of 538. However, the company's debt repayments, cash payments, and for dividends and repurchase of common stock of 2,220 resulted in an overall decrease of cash of 152. Overall statement of cash flow indirect method. Using the alternative approach to reporting cash from operating activities, the indirect method, we will present the same amount of cash provided by operating activities. Under this approach, we reconcile Acme's thinking of Padme, Acme's net income of 2,210 and the operating cash flow of 2,606. To perform this reconciliation, net income is adjusted for the following: A, any non-operating activities; B, any non-cash expense; and C, changes in operating working capital items. The only non-operating activity in Acme's income statement is sale and equipment. It results in a gain of 205. The amount is removed from the operating cash flow section. The cash effects of the sale are shown in the investing section. Acme's only cash expense was depreciation expense of 1,052. Under the indirect method, depreciation expense must be added back to net income because it was a non-cash deduction in the calculation for net income. Changes in working capital accounts includes increase and decreases in current operating assets and liability accounts. The changes in these accounts arise from applying accrual accounting, that is recognizing revenues that they are earned and expenses when they are incurred instead of when the cash is received or paid. This makes a working capital adjustments under the indirect method. Any increase in current operating asset account is subtracted for net income, and a net decrease is added to net income as described above. The increase in account receivables, for example, resulted from Acme's recording income statement revenue higher than the amount of cash received from customers. Therefore, to reconcile back to operating cash flows, the increase in accounts receivables must be deducted from net income. For current operating liabilities, a net increase is added to net income and a net decrease is subtracted from net income as described above. The increase in wages payable, for example, resulted from Acme's recording income statement expenses higher than the amount of cash paid to employees. Exhibit 9 presents a tabulation of the most common types of adjustments that are made to net income when using the indirect method to determine the net cash flow from operating activities. Accordingly, for Acme Corporations, the $55 increase in accounts receivables and $707 increase in inventory are subtracted from net income, and the $23 decrease in prepaid expenses is added to net income. For Acme's current liabilities, the increases in accounts payable, salaries and wages payables, income tax payables, and other accrued liabilities are added to net income, and the $12 decrease in interest payables is subtracted from the net income. Exhibit 10 presents the cash flow statements for Acme Corporation under the indirect method by using the information that we have determined from our analysis of the income statement and a comparative balance sheets. Note that the investing and financing sections are identical to the statement of cash flow prepared using the indirect method. Conversion of cash flows from indirect and direct method. An analyst may desire to review direct format operating cash flows to review trends in cash receipts and payments. If direct format statements is available, cash flows from operating activities reported under the indirect method can be converted to the direct method. Accuracy of conversion depends on adjustments using data available in published financial reports. The method described here is sufficiently accurate for most analytical purposes. The three-step conversion process is demonstrated by the Acme Corporation in Exhibit 11, referring again to Exhibit 6 and 7. The Acme Corporation's income statement and balance sheet information begin to disaggregating net income of $2,210 into total revenue and total expense. Next, remove the non-operating and non-cash items. For Acme was therefore remove the non-operating gains and sales of equipment of $205 and a non-cash depreciation expense of $1,052. Then convert accrual amounts of revenue and expenses to cash flow amounts and receipts of receipts and payments by adjusting for changes in working capital accounts. The results of the adjustments are the items of information for the direct format of operating cash flows. These line items are shown as a result in step 3. Cash flow statement analysis. The analysis of a company's cash flow can provide useful information to understanding a company's business and earnings, and for predicting its future cash flows. This section describes tools and techniques for analyzing the statement of cash flows, including the analysis of sources and uses of cash and cash flows, common size analysis, and calculation of free cash flow measures and cash flow ratios, evaluation of sources and uses of cash. Evaluation of cash flow statements should involve an overall assessment of the sources and use of cash between the three main categories, as well as an assessment of the main drivers of cash flows within categories as follows. Evaluate where the major sources are and uses the cash flow are between operating, investing, and financing activities. Evaluate the primary determinants of operating cash flows, investing cash flows, and financing cash flows. Step 1, the major source of cash for a company can vary from its stage of growth. For a mature company, it is expected that a desirable operating activity are the primary source of its cash flow. Over the long run, a company must generate cash from its operating activities. If operating cash flows were considered consistently negative, a company would need to borrow money or issue stock to fund its shortfall. Eventually, these providers of capital needs to be repaid for operations, or they will be no longer willing to provide capital. Cash generated from operating activities can be used in either investing or financing activities. If the company has good opportunities to grow the business or other investment opportunities, it is desirable to use the cash in investing activities. If the company does not have profitable investments opportunities, the cash should be returned to capital providers of financing activities or for a new growth stage company. Operating cash flows may be negative for some period of time as it invests in such assets as inventory and receivables. This situation, okay. In summary, major points have considered at the step are: what are the major sources and uses of the cash flow? Is operating cash flow positive and significant to cover capital expenditures? Let me drink my water. Step 2. Turning to the operating section, the analyst should examine the most significant determinants of operating cash flows. Companies need cash to use in operations. For example, that shouldn't be a shock. So when we look at this in summary, we have to look at what are the major determinants of operating cash flows. Is operating cash flows higher and lower than the income, and why is it so? And how consistent are operating cash flows? Within the investing section, you should evaluate each line item. Each line represents either a source of or use of cash. This enables you to understand where the cash is being spent or received. This section will tell you how much cash is being invested for the future in property, plants, and equipment, how much is used to acquire entire companies, and how much it is put aside in liquid investments such as stocks and bonds. It will also tell you how much cash is being raised by selling these types of assets. If the company is making major capital investments, you should consider where the cash is coming from to cover these investments. If assets are being sold, it is important to determine why and to assess the effects of on the company. Within the financing section, you should examine each line item and understand whether the company is raising capital or repaying capital and what the nature of its capital sources are. If the company is borrowing each year, you should consider when repayments may be required. This section will also provide dividend payments and repurchase of stock that are alternative means of returning capital to owners. It is important to assess why capital is being raised and repaid. We now provide an example of cash flow statements and evaluation. Okay, so common size analysis of the statement and cash flows. In common size analysis of a company's income statement, each income and expense line item is expressed as a percentage of net revenues or net sales. For the common size balance sheet, each asset, liability, and equity line item is expressed as a percentage of total assets. For the common size cash flow statement, there are two alternative approaches. The first approach is to express each line item of cash inflows or outflows as a percentage of total inflows and outflows of cash. And the second approach is to express each line item as a percentage of net revenue. Exhibit 13 demonstrates the total cash flows, total inflows, and total cash outflows methods for Acme Corporation. Under this approach, each of the cash inflows is expressed as a percentage of the total cash out inflows, whereas each of the cash outflows is expressed as a percentage of the total cash outflows. Panel A, Acme's common size statement is based on the cash flow statements using the direct method of presenting operating cash flows. Operating cash inflows and outflows are separately presented on a cash flow statement, and therefore the common size cash flow statement shows each of these operating inflows and outflows as a percentage of total inflows or outflows. In Panel B, Acme's common size statement is based on cash flow statements using the indirect method of presenting operating cash flows. When a cash flow statement has been presented using the indirect method, operating cash inflows and outflows are not separately presented. Therefore, the common size cash flow statement shows only the net operating cash flows as a percentage of total inflows or outflows, depending on whether the net amount was a cash inflow or outflow. Because Acme's net operating cash flow is positive, it shows as a percentage of total inflows. Exhibit 14 demonstrates the net revenue common size cash flow statements for Acme Corporation. Under the net revenue approach, each line item in the cash flow statement is shown as a percentage of net revenue. The common size statement in this exhibit has been developed based on Acme's cash flow statements using the indirect method of operating cash flows and using net revenue. Exhibit 6, each line item and reconciliation between net income and net operating cash flows is expressed as a percentage of net revenue. The common size format makes it easier to see trends in cash flow rather than just looking at total amounts. This method is also useful to the analysts in forecasting future cash flows because individual items in common size statements are expressed as a percentage of net revenue. Thus, once the analyst has forecast revenue, the common size statement provides a basis for forecasting cash flows for these items with an expected relation to the net revenue. free cash flows and the firm and free cash flow to equity. It was mentioned earlier that it is desirable that the operating cash flows are significant to cover capital expenditures. The excess of operating cash flows over capital expenditures is generally the free cash flow. For purposes of valuing a company or its equity securities, an analyst may want to determine and use other cash flow measures, such as free cash flows to the firm, FCFF, or free cash flows to equity, FCFE. FCFE is the cash flow available to the company's supplier of debt and equity capital for all operating expenses, including income taxes, have been paid, and necessarily investments in working capital and fixed capital have been made. FCFF can be computed starting with the net income as such. Okay. CFO represents cash flows from operating activities under US GAAP or under IFRS when a company has included interest paid in operating activities. If interest paid was included in financing activities, then CFO does not. It's not Chief Financial Officer. It's kind of weird to think of the acronym as such. The CFO does not have to be adjusted to the integer of 1 minus tax rate. Okay, kind of makes sense. Cash flow ratios. The statement of cash flow provides information that can be analyzed over time to obtain a better understanding of the past performance of a company and its future prospects. This information can also be effectively used to compare the performance and prospects of different companies in an industry and in different industries. There are several ratios based on cash flows for operating activities that are useful in the analysis. These ratios generally fall into cash flow performance, profitability ratios, and cash flow convergencies, solvency ratios. Exhibit 15 summarizes the calculations and interpretation of these ratios. Summary. The cash flow statement provides important information about a company's cash receipts and cash payments during the accounting period, as well as information about a company's operating, investing, and financing activities. Although the income statement provides a measure of company's success, cash and cash flows are also vital to a company's long-term success. Information on the sources and uses of cash helps creditors, investors, and other statement users evaluate the company's liquidity, solvency, and financial flexibility. Key concepts are as follows. Cash flows activities are classified into 3 categories: operating activities, investing activities, and financing activities. Significant cash flow transactions activities, if present, are reported by using a supplemental disclosure note to the cash flow statement. Cash flow statements under IFRS and US GAAP are similar. IFRS provides companies with more choices in classifying some cash flow items as operating, investing, and financing activities. Companies can use either the direct or indirect method for reporting their operating cash flow. The direct method discloses operating cash inflows by sources, e.g., cash received by customers, cash received by investment income, and operating activity cash flows by use, e.g., cash paid by suppliers, cash paid by investors, cash paid for interest. In the operating activity sections of the cash flow statement, the indirect method reconciles net income and operating cash flows by adjusting net income and for all non-cash items and the net changes in the operating working capital accounts. The cash flow statement is linked to the company's income statement and comparative balance sheet and to data on those statements. Although the indirect method is most commonly used by companies, and an analyst can generally convert to an approximation of its direct format by following a sample of 3 simple processes. An evaluation of cash flow statements should involve an assessment of the sources and uses of cash and main drivers of cash flow within each category of activities. the analyst can use common size statement analysis for cash flow statements. Two approaches to developing the common size statements are the total cash inflows and total cash outflows methods for the percentages of net revenues method. The cash flow statements can be used to determine free cash flows to the firm, the FCFF, and free cash flows to the equity, the FCFE. The cash flow statement may be used in financial ratios that measures a company's profitability, performance, and financial strength. Okay. There we go. So that is reading 25. We have finished reading 25, understanding cash flow statements. And I do hope my readings have been helpful, and my talks about what I've been drinking on this specific reading has been somewhat entertaining. Okay, so we're going to be doing financial analysis techniques, which is reading 26, which is a kind of a heavier chapter in our next reading. And without further ado, I hope to see you guys there. Okay, goodbye.